Hey folks, how you doing? It's Daniel Rashid. Thanks for joining me today. I thought I'd do a series on getting into purchasing your first home or investment, and sort of the steps, and I mean like real basics. So if you're already investing, you don't really have to watch this series. It doesn't hurt to brush up on what the banks are looking for, but let's get into it. So what do the lenders require? When it comes down to it, they're looking for two main parameters: your GDS and your TDS. And those are your gross debt service and your total debt service. Gross debt service relates to anything to do with the property, your home expenses, your mortgage, your heating, your utilities. If you're buying a condo, I believe they split half or use half of your condo fees, which is something we can discuss later, towards that service ratio. Um, so GDS, the number to keep within is 32%. When you meet with these bankers or mortgage broker, they'll discuss what that means at the end of the day. So if you are looking at purchasing a property, it doesn't hurt to calculate those ahead of time. So when you meet with them, you'll have something to discuss. And then it rolls into and plays off of TDS, which is your total debt service. And that goes and dives into everything: your loans, your car payments, your visa expenses, your phone expense. This is the thing that could really wing your application in terms of kind of making it difficult for you to purchase if you do not have, or if you can't stay within 40% of that recovery cost. And they'll again explain that to you at that time. So from there, we're looking at getting pre-approved. And if your parameters are all right and your numbers and your percentages for your debt service are looking good, then you can get a pre-approval from the bank. And what that looks like is it is a pre-approval. So it's not based off a purchase. If you had a purchase contract together with a realtor or whatever, what have you, don't matter. You can get a good idea from the bank whether or not you can purchase that property. Otherwise, you're doing your homework before you dive into the field, which I really highly suggest that you get that pre-approval before you dive in to home hunting. It could be a lot of wasted time. It could be an emotional journey, because you might like something that you just really can't afford, and it's best to stay within your lane to a certain degree. It is good to kind of push the envelope a little bit, but knowing where you stand in terms of financial affordability in purchasing a home or investment will save you a ton of time. And it's just take your steps. Make sure that you get your pre-approval done. And that doesn't mean that you can buy because things change from time to time. They will tell you the same when you meet with bankers. You can get a new debt, or you might buy a car in that time, or you shouldn't. But things happen in life, and you might pick up something, or your situation may change with your career. Hopefully it does not. But get the pre-approval, and then you can start your journey. So when you have pre-approval, you're dealing with terms, mortgages, and what those terms look like, how much interest you're going to be paying on that mortgage. You'll have a great idea what's involved and what you're looking at for payments, and it just sort of helps with that parameter. It's also going to bounce off your credit rating, which is very good to know offset, and watching your credit is an important thing as well. Some of these services online, I think in Canada we have Equifax and TransUnion, and those two companies, you can draw on your credit rating. Some of the banks offer it for free, so look out for that. They offer it quarterly on some mobile apps. I believe some of them should be able to log in online. I use mine with CIBC, and I can log in every few months, kind of see where I stand on my credit rating. But Equifax is something good to watch in case, protects you from identity theft. You can see some loans that you can actually dive into. The big difference is that you can dive into the details of the loan or your credit history, rather than if you're looking at an app, you just get a number. So you could sign up for a couple of months to sort of dive in and dissect, what you're dealing with in terms of your financial, or how the credit bureau sees you, and what loans are out there. Maybe there's something that you didn't see, or maybe someone signed in your name or something, which would be unfortunate. So what terms are best for your mortgage? You're going to be dealing with two main things. You got a fixed mortgage and a variable mortgage. And fixed is the rate, which what I would probably jump into right now for 5-year fixed would stay the same. That you're not playing, dealing with any surprises. Variable changes with the time. If the interest drops low over the next couple of years, you're paying lower interest. But if it goes high, you're going to be paying higher interest. Sort of that's how that works. So generally the variable rates should be less, and if they're not, then I would be hesitant to sign on to begin with. But if they are less, then you can kind of maybe view the history of where interest rates were. A lot of people have had success with variable mortgages. I've done more fixed, just it was my preference at the time, and yeah, depends on what direction you take with that. Choose your payment options. It's best to pay these mortgages back fast, but me starting out, I had to really leverage myself to purchase any property. So you might be in the same shoes, and if you're not, then I would probably say you do 20% down because you do a conventional mortgage with the bank. You'd avoid these insurers like CMHC, which is a Canadian Housing Mortgage Corporation, I believe Genworth, and I forget the other main contender, but those companies are federally funded and they cover the up to the 15% of the mortgage. So basically you can go into a house with 5% down, and they cover that extra 15%, but you're paying extra premiums for that. But at the same time, 15% of a home could be quite expensive to come up with a down payment. The down payment's always a very difficult thing to begin with, so adding more stress on that, you have to weigh out your situation and see what you can do. 20% is the best. Can't do it, then that's, then you have to resort to one of these premium lenders, which we have access to. Look online for the government programs to take advantage of. There's a lot of tax benefits. There's RSVP, like first-time home buyer plans. I believe the limit's about $25,000 that you can adjust into an investment, pull out the tax incentive, and use it towards your purchase of a home without penalty. I think you have 15 years to pay it back. So there's different programs. I know locally, our municipality, our government will fund a first-time home buyer down payment. So I think it's 5%. I'm really kind of unclear about those particular rules, but there is incentives for your first-time home buyer. And your district may be different, your province may be different, and always look into what incentives you have. There's green energy programs all across Canada. There's tax relief brackets, like I think the e-savings account, you can ingest $5,000, and that gives you like a $750 savings, which can be and mean a lot to you. But take advantage of the programs. They're out there for first-time home buyers, and take advantage of them. We'll dive into more in terms of your roadmap for purchasing a property. There's plenty to cover, and any of those things I discussed, you can find out more information from online. Realtor.ca would probably have some information about your map, your home buyer map. Any realtor would help you. There's tons of information online that you can find. Thanks for joining me. I appreciate you taking the time to watch this. Hopefully that helped. If there's any questions, toss me a note, make a comment. I'll answer them, and we can go from there. And if there's anything that you want me to divulge more or go in more in detail, just let me know, and we'll chat about it. Take care.